Well, good morning, everyone. This is Michael Douville coming to you from beautiful Phoenix, Arizona. It's April 20th, 2021, and this is another Creating Real Estate Wealth live webinar, and it's dedicated to you. Now, West USA has been kind enough to give me this platform for this last year and some change, and the whole crux of this was to bring topics to you to make you financially free, to spark your ideas, to get some motivation for you to build revenue, build wealth, get out of debt, build reserves, and get your life absolutely wonderful. That is the goal. You're in a great market to do that, and we're here to help you in every way possible for you to actualize your life, become financially free, and go do those things that really are important to you. Go make your life better. And this has been my joy, and I have really enjoyed it. And I want to thank you for listening to me. This was absolutely outstanding. And today is the culmination of all that we've been doing. We've been following my book, and today is the last chapter. And this is probably the most important topic we can have. It's why are we doing this? Where are we? We're going to explore a little bit of my timing model, talk about how to invest and when to invest. But first, next week, we're going to talk about Chapter 1, different income classes, and start over again so that you have some ideas, and we'd love you to get involved. And that's next Tuesday at 10 a.m. So today's topics is, why does this strategy work in any marketplace? Now, this is kind of controversial, but is it possible to time the markets? Now, you know, I work on an 18-year timing model. That 18-year cycle has been evident in the United States for hundreds of years. The data actually goes back pre-revolution. We'll explore my timing model today, and we'll tell you what's going on in the market, where I see it. You guys are going to know where the market is, but I'm going to kind of give you a little bit of a forecast. And we want to talk about how you can get involved, how you can just go from listening to this and thinking about it to really putting these topics into action for yourself so that you can better your life. And I'm going to tell you, I keep talking about the strategy, but the moment you start the strategy, your life starts to get better. Almost instantaneously, it just starts to get better. And it doesn't take very long at all before you're starting to see real results. So let's start today. What can we talk about the current market? Why does this strategy work in every marketplace we're in? It's because it's a get rich slow program. It's a consistent program. It's buy a property every year, no matter what the market is. We want to be increasing our portfolio, increasing our wealth. But we do that with a strategy. We do that with business acumen. We do that because we're choosing a property of 1 year, just one property a year. You have a whole year to choose that property. And the property has to fit in certain parameters that we go through in our workshops. We explain what the parameters are because every property is going to rent, particularly in the great markets of the United States, Florida, Texas, and Arizona. There's not a property that's not going to rent. But not all properties are good rentals, and we want to choose the very, very best we can. So I'm going to get a little wound up on this one. I'm not going to be doing this for a while, so I want to let you know that this is going to run about 25 minutes. We're going to talk, these are pretty important topics we're going to talk about. We're going to talk about my cycle and how it has a predictive rhythm. We're going to talk about how, because of the predictive rhythm, you as an investor can remain flexible. You're going to know when to invest, when not to invest, when to be aggressive and not to be aggressive. And we're going to discuss that. This is going to make you wealthy, which is what I'm here to do. It would make me so absolutely proud of you guys to do this. So is it possible to time the markets? Well, you know, the bond market is on about a 76-year time frame. It's about 75 to 78 years with rates going down. I'm sorry, It's 35 years to 38 years going down. That makes it 70 to 76 years. And it's 35 to 38 years going up. And that's the bond rhythm. That's the interest rate cycle. We also have cycles in the stock market. They're very predictive. You can look at them, talk to your financial advisors. I'm sure that they know about these things. In the real estate cycle, ours is about 18 years from top to top. So we have 18 years cycle with which we can do business, and knowing where you are in that cycle makes your life so much easier. Again, we are cash flow investors. So we're multiple cycle investors. So not only are we going to invest throughout the completion of the cycle, the entire cycle, but when you get to be my age, we've gone through a few of these. So we want to be not only a full cycle investor, but a multiple cycle investor. Now, we invest for cash flow. Now, there's lots of ways to make money in the real estate industry. When we're developing and creating wealth, one of our prime ingredients is cash flow, because the cash flow is going to change our lives. We need that cash flow to pay the bills. We need that cash flow to buy gasoline. We need that cash flow to take your baby out to dinner on a Saturday night and to go on a cruise and go climb the Eiffel Tower. We need that consistent cash flow coming in. And once that cash flow is coming in, you don't ever want to not get that cash flow. That means that we're going to invest over a lifetime, because investing and becoming a wealthy cash flow investor, if you're going to create wealth, it is not a 15-year or an 18-year cycle. It's a lifetime journey. We are going to create cash flow and wealth that's going to last you your entire life. It's going to be a generational wealth so that you can give this to your kids or your grandkids. And we've talked about the fact once you develop wealth, and I'm going to tell you, you are going to make so much money, you're going to be amazed, and you're going to have money for generations. And we've talked about the fact that there's only two ways to do this. One is to restrict the capital. The other is to teach them how to do this. And of course, the old age adage is that you don't just give them a fish every day, you teach them to fish. So once they learn how to do this, it's easy, it's a strategy, there's guidelines, it's a business, and it's replicable. You can just do this over and over and over again. It's not rocket science, it's just the system, and you can learn this. So we have an acquisition phase, we have a sell phase. The investors always need dependable cash flow, so we know when to be aggressive and when not to be aggressive. And investors sometimes think, well, we've had this big run up, it's not going to go up anymore. And that is where we are today. I get this call all the time. And we're going to talk about where we are in that cycle and where we're going to end up in that cycle. So this is a very, very important segment that we're going to talk about today. So let's see, where are we today? Well, we just got this from Zero Hedge. They were kind enough to allow me to use this slide. It's talking about the 2020 appreciation nationally in the United States. Across the board, we had 11% national appreciation. Now, typically you should get 3 or 4%. We were just ecstatic to get that. So typically here, over my research, now we've been here for 40 years, our research goes back a long, long ways. But in the 80s and 90s, we were consistently getting 3.98% average for years and years and years. And if you think that you put down 20% and you just get a 3% appreciation rate, just 3%, below our national average, below our regional average, that 3% would generate you a 15% capital gain year after year after year compounded. Nationally, we're looking at 11%, almost 4 times what we normally look at just to make our parameters. So the market is just on fire. And that's taking these little places that really probably have 0 to no growth. A lot of places across the United States, people are actually leaving, coming to the great markets of Florida, Texas, and Arizona. So their marketplace gets thrown into the mix of Florida, Texas, and Arizona, where we're seeing explosive growth because the trends are in place. People are moving to these places, And these are really decades-long trends where you can invest your investable dollars and feel fairly reasonably safe that you are going to get a return on your money for a very, very long time. Now, we've talked about the fact that our timing model, this is March 2018, we talked about the fact in our timing model that we are going to have a correction in an ongoing bull market. Our timing model exactly showed that. It came down here. If you look back on our work, we said it's going to end the fourth quarter of 2019. It certainly did. You can see it pop. We also said we're going to have a short correction. Here's that correction right here. This would have been March, April, May of 2021, and it's off to the races since then. So we identified these as buying opportunities. So can the model work for you? Absolutely. We got more aggressive this because we knew this was a correction in an ongoing bull market. Now, this is residential. Now, real estate in offices and retail have been lagging. And of course, other markets across the United States like New York, Chicago, Portland, Seattle, they're lagging a little bit too, but they are now starting to appreciate. And I would say you can start looking at, I really follow residential, so maybe I'm outside my wheelhouse here, but I believe all real estate is going to go up and it's going to continue up, and we've had a very, very big spike. Let's go to the next slide and let's talk about this one. This is my proprietary. Now, of course, I've simplified it because you don't want to see all the squiggles, but we want to talk about how this cycle repeats and where we are. Now, when you get to be my age, we look back. This cycle is following the last cycle very, very closely. So if we take a look at a simplified cycle, this peak right here is going to coincide to that December 1999 slowdown where we had a correction in an ongoing bull market. Now, again, we're using national figures. So in your own region, this may change a month or two, one way or the other. This could have a little bit of a change because obviously things in Boston don't necessarily move the same as in San Diego or in Oklahoma City, but they all kind of go along together. Now, in December 1999, we had a correction in an ongoing bull market, just like we did this year, March of 2018. We got that pop coming out of December 2019. It came back up. We said we were going to have a slight correction. Now, ours was shorter, but in the last cycle, February 2002 marked the beginning of, again, a small correction. This would have been related to our March 2020, a correction again in an ongoing bull market. And after that correction was over, and keep in mind, it was only a few months long. If you remember, it was not very, very long at all. It was a slight correction. We all felt it. We predicted it in January of 2020. I didn't know why it was going to happen. Who would have thought that we're going to have this COVID thing where a whole country, a whole world would shut down and have this terrible, terrible recession and a problem with the virus. But nonetheless, it was on our charts. We could see it. We knew what was going to happen. We didn't necessarily know why. But I'm going to tell you that it has been tracking, again, very, very similar to what it was on our last cycle. And I think right here is going to coincide where we're at right now. I think this is coinciding to about 2003. Now, if you remember, in the last cycle in 2003, the economy was just starting to recover from the dot-com bubble. We had a recession in the 2001-2002 timeframe. Real estate was counter-cyclical as it is now. There's a recession on Wall Street. There's a problem on Wall Street. But again, real estate is its own separate asset class and did not participate in that recession. And if you recall, in this last downturn, you saw what happened on Wall Street. Wall Street took a terrible, terrible drop, and real estate recovered right away and has been going ever since. Now, this is called the accumulation phase, and that's where we're in. And you can see it's a fairly steep appreciation, which is what we are experiencing now. we have a very strong appreciation, but it doesn't look like it's going to end at any time. And if we follow last time's cycle, which is what I think we're going to do, there's going to be a distinct change beginning of 2000 or in the middle of 2022. If I were going to say textbook perfect, and again, nothing in the real world is textbook perfect, but mid 2022, we should start seeing a frenzy in the marketplace, more pronounced than what we have now. So here we are. We're probably in the middle of this accumulation phase. This gives you all this time of accumulation to pick up properties and get ready for the explosive phase, because from here, this is going to be 2005 on steroids. So from July 2022 to a top, I'm thinking somewhere around 2025. When it starts getting up here, things are really going to start percolating, and you're going to see some amazing price appreciation, particularly in the great markets of Florida, Texas, and Arizona. In Maricopa County, we're going to go like mad. Now, one of the concerns I hear all the time is, are we overbought? Do we have too much price appreciation? And it has been pretty amazing to see prices going up. Here's my answer to you, is that yes, prices are going up, home values are going up. There's a lot of demand on these properties, very similar to 2005. Homes were selling instantly in 2005. However, there is a distinct difference. In 2005, rents really lagged purchase price. Rents were in the basement because people were not renting these properties. There were so many vacant properties available because no one was intending to occupy the properties. They were just buying them and shuffling them. They'd buy from one investor and sell to another without even putting a tenant in place. Today's market, we have demand on housing, we have demand to purchase, but we have that same demand on rental. So yes, prices of rentals and our homes are going up, but rents are going up right along with them. And that delta in between, the delta that we talk about, that delta is remaining constant, and your return on investment is remaining constant. And as prices go up, the rents go up with it, signifying to me that we're still in a very, very healthy marketplace, a very vibrant marketplace. Now, we have a shortage of housing here in Maricopa County, have it in the major markets across the country. If you look at all the graphs, you're going to see that for the last 10 years, we've been underbuilding across the United States, and that underbuilding is finally coming to light, and it's causing some problems. We also have some major demographic trends going on. The great markets of the United States, Florida, Texas, and Arizona, no one can deny that these trends are in place. They've been in place for a really long time. They've been accelerated by the COVID problems, and people are moving to these, and it's time for them to go. They're leaving some of the markets that across the United States, they're leaving California and Oregon and Washington and Minnesota, Wisconsin, Illinois, coming to the great Southwest. And of course, we're seeing that same type of migration coming to Texas and coming to Florida. And this is a decades-long trend, which means that we've got plenty of time for fortunes to be made. Now, we're going to look up here, and if you follow my seminars, we talk about the fact in the 2023-2024 timeframe, we want to review our portfolio because we're full cycle investors. Now, in the last debacle, now I was here in Phoenix. What a terrible place to be a real estate investor in 2008, 9, and 10. I went to Australia for 3 months with my kids because I wasn't selling any properties. I'm a cash flow investor, and my cash flow remained intact. My management company sent me a check each and every month, and I went worry-free to Australia because I didn't care what was going on in the values. All I was concerned about was making sure my tenants could pay their rent. And we are dealing with a basic commodity like food, water, and shelter, and people need a place to live. And we're in a marketplace where we don't have an overabundance of vacant properties. And yes, we're building properties, but we have more people coming in and they're absorbing all those properties. So at this juncture, we're pretty doggone good shape. Now, once we start getting up here to the top of the cycle, we have to start doing some other strategies, which we have. You're more than happy to talk with us. You're more than happy to come to our workshops, but we're expecting this and we're anticipating it, and we're going to take care of our portfolio. And depending on who you are, there is a suitability. If you're 80 years old, you might want to lighten up on some of these, or maybe not. Depending on who you are, we're more than happy to talk to you, and certainly involve your spouses, your financial advisors, your tax accountants, your estate planners. We're more than happy to develop a plan as to how we're going to do this, but there is nothing, absolutely nothing to fear. We are going to be prepared for this, and we are all going to make a fortune from here to here. It is in the cards. I see this now. Can I be wrong? Absolutely. Could we have a Mad Max event come along? Certainly. But so far, so good. I'm not going to say you shouldn't be cautious. You shouldn't always take a look and see what's good for you. We want to make sure that you question absolutely everything. We're here to help. We're not saying that you should have all your money in real estate, but maybe a portion of it should be in real estate because it's so compelling. You're going to get not only capital gains, you're going to get cash flow, and it's going to run your life, and a growing cash flow, so that you're going to constantly keep getting more and more cash flow, but it's a great inflation hedge. And one of the things people say, well, what could possibly happen? Well, I'm more concerned with what's going to happen, not why. Why it could happen? Well, I can think of 10 scenarios. One might be inflation. We could get inflation going and prices just get driven through the ceiling. What happens if we change the underwriting? What if we decided that a 400 credit score is more than enough to get an FHA, and you see people from everywhere be pouring into the marketplaces? But we just need to make sure what's going on, and we're more than happy to consult with you, your loved ones, your financial advisors. We're here to help in any way we possibly can. I want you to be empowered. I want your life to be your own. I want you to go and do all those things that you're here to do. And I want you to sleep well at night. So I want to thank you so very much for putting up with me for the last year and a half. You've allowed me this platform. Thank you for listening to me. If you want to become a residential rental investor, there's a few things that you can do. First thing, me as an author, I would love you to buy my book. Go buy Creating Real Estate Wealth. Go by creating a real estate money machine and retire with income. It's available absolutely everywhere. We'd love you to do that. Just hit on this link and you can buy my book. We also have, I'm putting together my book. I have another one called Real Estate Investing for Beginners. It's going to be published this week. You can subscribe to Creating Wealth playlist on YouTube. You're always welcome to call us. We have a workshop coming, and it's going to be Creating Wealth for Beginners. I'm going to take you from having nothing to take you through the process of getting your very first house. And I'm going to tell you, the last time we did a workshop, 62.5% of the people who attended our workshop bought a house in the first 6 months. They bought a rental in the first 6 months that worked, was sitting in our parameters. It fit all the calculations. 62.5% of those attending bought their very first rental. I am so proud of them. Be watching for that. You can see that on our West USA calendar. And if you have any assistance, or if you're an experienced residential rental investor, you are more than happy to contact me at creatingwealth@westusa.com. If you've got comments or thoughts, you're welcome to reach us at creatingwealth@westusa.com. We're here to help you. We want you to become independently wealthy, financially free. We want you to do this for generations. Teach your kids. Now, next week, we're going to start again with Chapter 1, talking about the asset classes. That's Tuesday next week. We'd like you to attend and listen to that. If you have any questions or you'd like to get a copy of that flyer, Creating Wealth at westusa.com, please buy my book. Watch this video. Heather will have this video up on YouTube this afternoon. If you like it, give me a big thumbs up. Join the channel. You can subscribe and watch my new book. It should be out this week or next, and it's Real Estate Investing for Beginners. I want to thank you so very, very much for listening to me all these months. It's been about a year, almost a year and a half since I've been doing it. Thank you so very much for this platform. I want to thank West USA for giving me this platform as well to bring my ideas to you. I hope, my fervent hope is that you found something that was of use to you, was valuable to you, and I hope that you take it and make it your own. My very, very best to you. Bye-bye now.